momentum is, in fact, if you looked at a momentum chart and compare it to a price chart, maybe you've got some of those handy. Price looks great because it went up and nipped out a new high. But when you look at momentum, there was a structure, like a floor on momentum that was very clear. It wasn't clear on price. And you broke it, and you're up under the floor right now, incrementally upticking. Meaning, when you got near the floor, a few months ago, in fact, the action started to slow to a snail's pace. Very incremental gains every day, 5, 10, 20 S&P points, et cetera, and now finally a new high. You're still up under broken momentum trend structures on NASDAQ 100 and the S&P. And you've lost your leadership. Mag 7 aren't Mag 7 anymore. And too many sectors are chuckling at this. And these are sectors that back in 2024 and early this year were up there with the S&P at the high, happy with it. Now suddenly they're not back up there. In January, the S&P dropped enough to cause our quarterly momentum of the S&P. That's not the price chart. It's not some short-term momentum metric. It's a fairly long-term metric. Broke structure, meaning if you looked at the momentum chart, you'd say, oh, the bridge on the River Kwai just cracked open. Okay. We had a spill. It didn't get going until late March, April, with some news, which is unfortunate. News is never a good driver. And we had predicted in the middle of that move that the low, a bounce point, we defined it as a bounce point. Meaning if you're in puts, you better be careful, okay? 4,800. It stopped at 48.35 and bounced sharply. That's when Trump said 90-day pause. And since then has crawled incrementally, but ever so steadily, back to the old high. Yesterday and today took it out. We got up to 60, 80 something today. Last I saw, we were dropping back to about 60, 40. So we did take out the high that was seen in February of this year. Okay. We still think, based on momentum, that the market is broken. This rally to a, quote, new high is a teaser. We do not trust it. We urge people not to trust it. Besides, there are better places to be anyway, and have been for several years. Monetary metals have beat the pants off of the stock market. People don't realize that, but if you do the measurements, you'll see that owning gold 3 years ago beat the S&P handily, not just the last 6 months. Okay. This topping action by the S&P and the NASDAQ very much caused me to have deja vu. Back in 2000, at the dot-com top, we put out a sell report on the first day of January of 2000 and said, get out of the market, it's topping. Okay. Sure enough, the market started to drop then, dropped sharply into February, about a 10% drop. But by March, it came back up and produced a new price high. Momentum still said, no, you broke stuff. You're no good. Don't trust me. And it labored all year. Well, it labored for the next 6 months anyway, through the summer, at, below, and above our point of exit that occurred in January. So it basically went to sleep. Didn't go up a lot more. It went up enough to make a, quote, new high. And it wasn't really until you got into 2001 that all hell broke loose on the downside. That's when the Fed cut rates, by the way, January of 2001. Then the other deja vu. Let's go back to 2007 top. In the close of December 2006, we put out a report and said, likely topping next year. And we put a price range. At that point, we were in the 1400s or 1300s, I think, in 2006. We said you go to 1550 to 1600 would be the topping zone. Okay. In May of 2007, the market worked its way back up and got to 1553, I think it was. So got up marginally into our zone, which, by the way, if you go horizontally all the way back to the year 2000, that's exactly where it peaked at the dot-com top. So the price guys see this thing, a peak at 1550 plus, a peak at 1550, and somebody sold it there thinking, oh boy, I'm going to sell the old high. They made a little bit of money because you dropped hard into August. Then what happened? You started to turn, and in mid-September, you're coming back up toward that 1550 level. to try to take it out, impress everybody, the Fed cut rates. You goosed the market up about 3 more weeks into October, got to 1575, precisely in the middle of our targeted range, but a new price high. In fact, not only above the May high of that year, but above the 2000 high. So a massive dual price level was taken out. And so what? If you're looking at a price chart, you should do what? Oh boy. Okay? That was it. That was the top. You ooze back down and all hell broke loose over the next year and a half, 2 years. Okay. Fed cutting rates all the way down. So now we have a similar situation. You make a high late 24, early 25. Most indexes, almost all indexes. The Mag 7 were up there cheering, along with it. You get a sharp drop into April. You work your way back up, and now in a limited horizon view, you've made new highs. S&P, NASDAQ 100, marginally, like 1% above that high. If you look, however, at the Mag 7, you'll see like only 2 of them are back to their highs. Third one's close, but that means only 3 out of 7 now. Okay, the rest of them don't even look like Mag 7 anymore. Okay, they're the lower half of the last year's range. And then when you go to sectors like commercial real estate, banks aren't making new highs. Dowd Industrials, they're not making new highs. They're not even that close. Healthcare sector looks like hell when you look even at the price chart. I can name more, but the point being that now we're making the new high. And you hear it on CNBC and Fox Business about, oh, boys, a new high. And when you look around, even just at price charts, something's wrong. It's very narrow. Momentum says there's something wrong. Don't trust the new high.
Despite record highs in the S&P and NASDAQ, momentum metrics tell a different story. In January, a long-term trend line snapped like a bridge cracking under pressure. This wasn't a short-term dip, but a structural break. While prices rebounded after March, fueled by news and political shifts, the momentum never recovered. The market's foundation quietly weakened, unnoticed by many. Today's rally feels eerily familiar. In both 2000 and 2027, markets broke to new highs right before major collapses. Momentum indicators warned then too, even as prices fooled investors with deceptive surges. Back then, structural weaknesses were ignored until late-stage collapses took hold. We're seeing the same setup now: shallow breadth, fleeting highs, and a market losing its real leadership.
Momentum is, in fact, if you looked at a momentum chart and compare it to a price chart, maybe you've got some of those handy. Price looks great because it went up and nipped out a new high. But when you look at momentum, there was a structure, like a floor on momentum that was very clear. It wasn't clear on price. And you broke it, and you're up under the floor right now, incrementally upticking. Meaning, when you got near the floor, a few months ago, in fact, the action started to slow to a snail's pace. Very incremental gains every day, 5, 10, 20 S&P points, et cetera, and now finally a new high. You're still up under broken momentum trend structures on NASDAQ 100 and the S&P. And you've lost your leadership. Mag 7 aren't Mag 7 anymore. And too many sectors are chuckling at this. And these are sectors that back in 2024 and early this year were up there with the S&P at the high, happy with it. Now suddenly they're not back up there. So even the price charts, if you'll survey the horizon, something's not going on here that should be going on, if in fact the new high means anything.
You mentioned that there's only 2 of the Mag 7 that are at or near.
NVIDIA would be one and Microsoft another. I think maybe Meta's getting close. But when you look at Google, look at Amazon, look at Apple, look at Tesla, those are the rest. They don't even look like, anything like the S&P or the NASDAQ. Something's happened. And then when you go to other sectors, too important sectors, too many important sectors. Healthcare looks like hell. An annual momentum of healthcare blew a structure going back 15 years. So it really looks like heck in terms of momentum. And that was one of the quiet, comfy sectors to be in for the last few years. Other ones I've written down, let's see, we got the bank sector not making new highs. Consumer discretionary used to be a leading, what you call a risk-on sector. In other words, when the market's strong, boy, it's a leader, okay? Look at an XLY chart sometime and tell me you're making new highs, okay? Something's wrong there. Healthcare. IWM, which is Russell 2000, it's not making new highs. It's not even that close. Okay, so and all these sectors were at new highs early this year, but now suddenly they're divorcing. So even with an unsophisticated analysis like that, just looking at some price charts, you're missing your leadership. This is phantom, So, but momentum tells us don't trust it. This is likely like the summer of 2000 when they took out the highs and made us look silly, but it turned out momentum was right. Or that October 2007 high, which took out all the highs of the prior 2000 and 2007, huge price breakout. As soon as it broke out, it was a short. Okay, so don't focus primarily on price.
Once market darlings, only 2 or 3 of the famed Magnificent 7 tech giants remain near their highs. The rest have faltered. Sectors like healthcare, regional banks, and small caps are diverging sharply from the main indexes. Price charts may still look bullish, but the momentum and sector breadth tell another story. This is no broad-based rally. It's dangerously narrow. The bond market has faltered, with 30-year T-bonds collapsing from brief rallies. Commercial real estate ETFs like VNQ and RWR show deep stress, some with mounting defaults on debt maturing in 2025-26. These aren't isolated tremors, they hint at systemic strain. Momentum indicators suggest this rally is a mirage beneath a cracked floor. When debt stumbles, everything else follows.
The AIs are still leading. Okay, that's extremely narrow. But not tech broadly. It's not doing the same thing. With the Mag 7, which was primarily tech, as we know, it's not leading anymore. But some of the other key sectors that have hefty weight within the S&P are just waving goodbye to it. They're divorced themselves from it, and nobody's making the note that I see, at least on analysts on CNBC or whatever, about notice that they're not making new highs. They're all just focused on the S&P and the NASDAQ 100. And I do not trust the rally. And our focus at MSA now, after we got our bounce, did I expect that bounce to lead to new highs? No, but I thought it would be a serious bounce. And it was far more than serious. You made a new high. It still doesn't change the momentum trend picture. It's broken. This rally, if you looked at a momentum chart, is a rally up under that which it broke. So if you looked at the momentum chart and saw the rally, you'd say, sell it there. But price says, oh boy, look at me. Usually momentum wins. In the high stranglehold of long-term rates, like 30-year T-bonds, for example, they won't get off the bottom they're trying to make. For several years now, since late 2022, the T-bond price has just gone sideways. We even gave it the benefit of the doubt because some momentum indicator shorter term said, no, you could rally up and maybe get the T-bonds futures, which have made lows like in the 110 area, get up into the mid 120s and nip out the rally highs of the last 2 years in that seeming basing process. And of course, if they rally, it means yields come down. Okay. They got up to 122, I think it was, in early April. From like the 110s, the 130, it looked like that rally was underway. And in 2.5 days, they were at 111 again. That's like a crash in the government bond market to have that kind of drop in 2 days. And since then, they've gone dull in the lower quadrant of the last couple of months' action, which is not good because look at commercial real estate. RWR is one ETF to look at. VNQ is another. They both hold about the same holdings. These are big companies that own real estate of industrial type nature, shopping centers, computerized centers, et cetera, et cetera. As I understand it, we don't pay attention to fundamentals. That sector is heavily in debt, and a lot of that debt is due in 2025 and 2026. So it's not just the consumer. You've got major companies. In fact, couple of months ago, I think the largest shopping center complex in the country defaulted on debt. I think it was tens of millions of dollars or maybe even a couple hundred, but it just defaulted on its debt. Well, something's happening. And if you look at the last few days in RWR, well, the S&P's done this, it's done that. And that's not a sector people are looking at. But you've got to look at the debtors, because when the debtors finally puke it up, there's a lender somewhere, right? Okay. The banking system. Watch the financial sector, because you can't afford to have the commercial real estate sector suddenly become a sideline headline. Oops, what's going on over there? Who cares about NVIDIA, suddenly? And you mentioned the dollar earlier. That's going to become a factor as well.